Great. Good morning, everybody.
By staying on the line, you consent to being recorded.
Oh, hang on. There we go. Good morning, everybody. Thank you for tuning in today. We've got a busy morning, actually. We've got a change of speaker. We're actually very pleased to get hold of Paul Niven from FTSE Investment Trust. But before we get there, then I and Richard will be running through some of the week's news. And then we've got something else to announce at the end, so please do stick around. So news first, 3 bits. So I'm going to look at Chrysalis and Downing, and then Richard's going to talk about Aberdeen property income. So Chrysalis first. These are charts from the AIC. Actually, our website's not quite working at the moment, unfortunately, and we are battling to get that fixed, but there we go. So the share price has been improving, and it's actually quite pleasing that it has been sort of recovering, despite the fact that it's had some setbacks. So obviously, when it broke down WeFox, that was a big negative. But nevertheless, the sort of movement has been encouraging. There's been lots of announcements that have been helping with that regard. This week, they've said we've put a 2-year 70 million credit facility in place. They can actually make that bigger by £15 million. There's an accordion facility too. And they're only going to use that to help accelerate the returns to shareholders. So it's not a permanent gearing facility. That's not the idea. It won't get more than about 8% geared based on what we've had at the end of June NAV. They've already got £45 million worth of cash. They've got some shares in Wise left, not very much those now, but £1.9 million worth. So we can start thinking about then getting going on the buyback. But then the situation's been vastly improved again this morning because they've sold feature space to Visa. They're going to get, the fund is going to get £79 million up front, and then another 10 million deferred consideration. We're not quite sure what the timing on that is, and we'll consider what the conditions are. But nevertheless, that is really quite encouraging. If they've got 89 million for it, that's a 20% premium to where it was valued at the end of June. That would add 2.5p to the NAV. And it also would be 3 times the amount of money that they've invested in the company, which is quite impressive, I think. That gives them a big chunk of liquidity. 195 million is equivalent to about 38% of the market cap, they say. And crucially, the announcement says this has allowed the company to begin the process of returning up to 100 million of capital to shareholders. So we should see buybacks fairly soon. I hope they're going to do it through buybacks. That would be the most sensible way of doing it. So just mop up the overhang quickly. Then the discount can start to narrow, and then they can start thinking about tenders and things. But buybacks, I think, would be the sensible way forward. We'll see what they do. Downing, this, I just don't understand why the discount is as wide as it is. You can see what the NAV's been doing. It's just been sort of marching up and up and up and up. We know that there was a bit of a sell-off around the start of the rise of interest rates, but it was entirely unjustified, I think. They have put up their discount rates. So that's been holding back this NAV appreciation. And then as rates start to roll over, that should come back into the NAV again. So this should further pick up again. It's a decent yield, 7% yield, but this is as much about the NAV appreciation, the total return, as it is about the yield. What they've announced this week is that they're selling their Swedish wind farm. They're going to get, again, slightly more than NAV for it, which is very encouraging. It just shows that the NAVs are reasonable. This little chart here is showing you how they've added value to it. So they're selling it for about 50% more than they paid for it. The asset performance has been good, and that's partly helped by the fact that they've put a new O&M, operations and maintenance contractor in there. They were able to renegotiate their insurance, and that saved about £1 million. They got a 5-year life extension and a longer lease term on the land that it sits on. All of that added the £5.5 million there. They invested some more money into it. Other bits and pieces, so the macro and stuff will help too. And they've already had £2.7 million flow off of this thing, so they're actually getting a decent return on it. Again, the money is going to be used sort of to well, initially to pay down the credit facility. So I think that's going to wipe that out. It was 22 million euros, so there's more enough money to do that. They've got more stuff to do for the hydropower portfolio. So they just announced that they bought another 3 Swedish hydropower plants on one river in the last set of results that came out. They've also got this one investment in Iceland. It did say hydropower portfolio, not Swedish hydropower portfolio. So I think they might do more stuff in Iceland as well. And then also they've got the bits and pieces that they're doing in terms of putting batteries next to those. And all of that is potentially quite lucrative for them and will push the NAV up higher again. But they also can buy back stock. So they're looking at doing that as well. And with the discount where it is, that's NAV enhancing too. So all of that, I think, means that this is definitely the wrong price. Now I'm going to hand over to Richard for a bit. So I think, Richard, I'll continue to drive, if that's all right.
Okay. All right. Thank you, James. Yes, so there's been a successful sort of conclusion to Aberdeen Property Income's managed wind up or wind down today. So this is the chart. It's sort of quite familiar with most of the listed real estate companies. Sort of end of 22 took a massive hit with higher interest rates, and then shortly after that they had a bid from Custodian Property Income REIT, and if you just go on to the next slide, James, which sort of made it was unsuccessful in the end, but it made the board think about what they wanted to do, and they proposed a sort of managed wind down, which got voted through by shareholders. And this week they've agreed a deal to sell the whole of the portfolio, apart from one sort of land holding they've got, for £351 million, which is, I think, quite a good outcome in the end for investors. So it's an 8% discount to the valuation at June, and it implies a NAV of about 64p, including the costs of doing this deal. So we look on the next slide. So 64p, that equates to a discount of the NAV of about 12%, just under 13%, but a premium to the share price yesterday, and a massive 20% premium to the share price when the managed wind down was approved. But also, shareholders will be thinking, well, how would this compare to if they did put through the merger with Custodian? So it's a 3% premium to what the original price would have been, or 62.1p. But after that, you might remember, after the deal was announced, the merger was announced, Custodian share price sort of fell off a cliff. At one point, it was valuing the deal at 50.5p. So it's a massive premium to that. Obviously, there would have been a price recovery if the deal had gone through. I would have thought, who knows how long that would have taken. So I think this is sort of a good outcome for API shareholders. And just a bit on the buyer, which is quite an interesting. So sorry, I'll just sort of go through the rest of the bits on the next slide, James. So yeah, it's due to complete at the end of November. Return of capital to shareholders through voluntary liquidation. Further costs will be applied to that. I'm not sure how much that will be. The third quarter dividend will still be paid. And then this land that they bought in Scotland, it was originally for sort of offsetting the carbon from their portfolio. So that's not part of this deal, and that's being separately marketed, and that's valued on the books at about 10 million. So they've still got that to work through as well. And then the buyer, on the next slide, is quite interesting. So it's Golden Tree Asset Management, it's a US firm. It's got 55 billion under management, but they're being advised by Farron Investments, who are taking a sort of minority stake in this deal, and they're going to asset manage the portfolio. But that's the team behind LXI. So it used to be Alvarium Management, and they tried to launch Special Opportunities REIT earlier this year, but didn't get that away. And they've obviously taken that to the private markets, and this is their first sort of venture. So that's quite interesting where that's ended up. But yeah, like I said, quite a successful outcome for API shareholders, I believe. And yeah, not one bites the dust.
Cool. Thank you, Richard. Sorry about my slide control there, all over the place. Actually, I looked at online that far radio thing, piece of land. They're marketing that at £12 million, and they only paid 7.5 for it. So I think that just shows you again what good managers the API lot were. I think it's a shame that this one's going, but there we go. Now let's talk to our guest this week. So Paul Niven, thank you very much indeed for doing this morning. I'll let you unmute yourself, and I'm going to, as usual, hand over to you and just tell us a bit about the fund and what it's trying to do, please.
Great. Well, very nice to see you, James. Thanks for inviting me on, and it's great to be here and to have the opportunity to speak to so many of your guests calling in. And I'll maybe just give a bit of a background with respect to the trust and some sense about how we view the outlook for the macro and market and what opportunities and indeed threats that presents to us and investors. So starting with this slide, and I'll give just a brief context with respect to F&C Investment Trust. I'm sure many listeners are familiar with the trust. We are extremely long established, more than 150 years, the oldest surviving investment trust with quite considerable scale, around £5 billion market capitalisation, FTSE 100 listed company. And our focus today is very much, as is indicated on this slide, exposure to growth assets. And that's consistent with our overarching aim, which is to deliver long-term growth in both capital and income. And the way that we seek to achieve that is through exposure to both listed and unlisted global growth assets. Now, that's in other words, listed equity and private equity. And we achieve this exposure, and again, I'll give some practical examples of this, by blending a range of focused, active strategies, but diversified across different geographies, different styles, and different approaches. So seeking to provide the benefit of focus in terms of individual portfolios, which are then aggregated to provide diversification across different, as I said, geographies, styles. And the whole ethos is one of seeking to deliver an outcome that has consistency. And also clearly in today's market, we're looking to deliver value for money for shareholders, and our ongoing charges are 49 basis points. We look to provide a one-stop shop or a single solution essentially for shareholders or investors that are looking for exposure to growth assets. So moving on, this slide just takes me into the backdrop that we've seen in terms of the macro environment for financial assets over the past year or so. And it shows the growth picture in terms of emerging markets, the US, Europe, and indeed the UK, in terms of growth forecasts, what people were expecting the overall growth picture for the economy to look like for 2024. And there's a couple of points I draw out without getting hung up too much in the numbers. Essentially, people have become much more optimistic, certainly for the 2024 outlook, for the US growth picture compared to where we were about a year ago. And similarly, more optimistic, albeit to a lesser extent, than we were a year ago for the UK economy. In contrast, Europe has seen a pretty stagnant picture actually in terms of optimism or expected outcome for 2024. So the US in developed market terms leading the pack, Europe and UK broadly similar, but the UK performing better than had been expected a few quarters ago. And if one looks at the outcome that is now expected for the UK and Eurozone and US and emerging markets for this year and indeed into 2025, the broad picture is one of moderate US slowdown, but actually a bit of an upturn in growth in the Eurozone and the UK. So a closer alignment between the growth outturns on those developed market bars. So rather than the US leading the way, as it did in 2024, and indeed it has in recent years, a closer outcome in terms of the growth picture. If you wouldn't mind moving on, James, we'll pick up just a bit more detail, again, at a high level. A lot of information on this slide. What this shows is surprises to consensus expectations of data releases. Now, what does that mean? Basically, when the line is above 0, for each of these areas, it's telling you that actual data releases are beating consensus expectations. So the data flow is better than people have expected. And this picture goes back to the beginning of 2023. And again, that blue line there, that's the US, and it's mixed in with the other areas. But the blue line is the US. And you can see through 2023, the US was largely beating expectations in terms of economic releases, delivering better growth actually than had been expected. More recently, it's a bit more of a mixed picture, and actually we turned negative, and I'll touch on this point in more detail, earlier this year, and therefore that US line fell below 0. In contrast, the UK, the grey line there, that has, until very recently, been surprising quite consistently, and that's consistent with this picture of the overall backdrop in terms of the UK economy being better than people had expected. And the other significant point I'd make here in terms of the Eurozone, that's the orange line there, that had a terrible period in 2023, quite considerable disappointment. There was a bit of an improvement earlier this year, but unfortunately, it's a pretty turgid picture in terms of the Eurozone growth. So Eurozone disappointing once again. If we move on, please, James, to the next slide. Now, one of the big issues over recent months has been this debate over whether the US economy will fall into recession or not. And there's a number of indicators that people in markets and more widely will look at to gauge the likelihood of recession unfolding in the US economy. One of those indicators relates to what's happening in bond markets and the yield curve. That is the difference between short-term interest rates and long-term interest rates. And essentially, when long-term interest rates are below short-term interest rates, that's an inversion in the yield curve, and that can precede a downturn in the economy, because essentially people are expecting that in the long run, inflation and interest rates will be cut. This is another indicator which caused some concern earlier this year and indeed over the summer. It's called the SAM rule. It basically looks at what's happening in terms of the labour market, and it looks at the unemployment rate. And essentially, the idea is that when unemployment rises from low levels, that has historically, once a certain threshold is reached, tended to precede a recessionary outcome. So if we wind the clock back just a couple of months or so, there was quite significant concern with respect to the US economy. There was some quite weak labour market data. The SAM rule, which I'm showing here on the slide, was triggered, for want of a better word. There was also a rise in interest rates by the Bank of Japan, which contrasted what's happening elsewhere. And there was ongoing concern about China, which has obviously undertaken some policy action in recent days. But frankly, there had been very little movement from a policy perspective. So that, plus some concern about valuation in markets, led to really quite sharp downturn in terms of equity indices over some of the summer period. Subsequently, quite a strong bounce back. And indeed, the S&P, the US Bellwether Index, now trading back at record highs. And I think I'm right in saying that overnight or yesterday we had the 42nd record high of the year for the S&P. So the equity market's been resilient, despite the fact that we have seen some of these indicators signaling a warning that a growth downturn may indeed unfold in coming months and quarters ahead. If you mind moving forward again, James, please. But despite some of these concerns about is there going to be a recession or not, and frankly, we think that it's more likely there'll be a soft landing, i.e. a slowdown without recession, than a hard landing, which would obviously be associated with a recessionary outcome. You can see on the left-hand side of this chart here, expectations for earnings growth globally are in the mid-teens for 2025. This shows what stock analysts expect in terms of the earnings outcome. So people are actually expecting here, and the line shows how those expectations change through time, a better outcome for earnings growth in 2025 compared to 2024. And frankly, that's a little bit difficult to believe. And you can see a bit of a disaggregation in terms of those numbers on the right-hand side there, where, for example, in the US, consensus expects a 15% growth in earnings compared to a roughly 10% growth in earnings expected this year. I don't have the detail on this chart, but there is an expectation that margins are going to increase in the corporate sector, and clearly that's in an environment where top line probably slows a bit as the economy does come off the boil. It is likely those expectations are a bit too high, frankly, in my view, and we will see some downgrades to earnings expectations. I think a key point, though, is if we get a soft landing, it is unlikely that we will get a material drop in earnings expectations. It might be high single digits. That would be still pretty good outcome. But as long as we get a positive earnings outcome and downgrades are not too material, that presents a reasonably good backdrop for equity markets. What I would say, though, is quite a lot's already, the analysts are already quite optimistic with respect to the earnings outlook for 2025. If you mind moving forward, please, James. And another key point, clearly, and I'm going to come and talk about interest rates in a second, is inflation. This looks at core inflation rates. One can look at headline inflation rates and so on, service and manufacturing inflation, labour market data. But the broad picture is inflation's come down. It's coming down closer to central bank targets, still maybe slightly above in some instances. But the picture on inflation has been has shown signs of steady progress. And importantly, I think it's fair to say, expectations on inflation from consumers and from market participants and from corporates remain relatively well anchored. And that's important just in terms of market expectations from a longer term standpoint. So there's been a resetting in terms of headline core rates of inflation, move closer to central bank targets. And with this slowdown, certainly in the US, that we're seeing in terms of the economic perspective, we are now in an environment where interest rates are coming down, and I'll show you this on the next slide. So what this shows is where we are in terms of current interest rates on the left bar there for the US, UK, and the Eurozone, what the expectations are for the end of 2024 in terms of what we can see from the market, and we can look at market pricing to extract this, and then what the expectations are for the end of 2025. Now, this year has had very volatile moves in terms of expectations, in terms of the outlook for interest rates. When we came into 2024, the market was really anticipating some very aggressive action from central banks in terms of cutting interest rates. That was in the face of a more pessimistic outlook, I would say, in terms of the overall economic picture. As it turned out, growth has been more robust than people had assumed. Inflation in some instances has been a bit stickier, and therefore interest rates compared to where we were at the beginning of 2024 expectations have not come down as quickly as had been assumed, but nonetheless they are coming down. So as you know, there's been a cut in the UK, there's been a couple of cuts in the Eurozone, and we had a half-point cut from the US Federal Reserve last week. Now that half-point cut was slightly ahead of market expectations. Market was pricing in between a quarter and a half, probably closer to a half, but it wasn't fully priced in. US Federal Reserve tends to follow or guide the market as to where it wants expectations to be set. and broadly gave the market what it was looking for in terms of that interest rate cut, which was quite a significant half-point cut, as I said. Nonetheless, there is another 1%, which is assumed in terms of rate cuts from the Fed this year. And into 2025, rates are expected to be below 3%. So more than 100 basis points assumed in the US in terms of interest rate cuts in 2025. If you contrast that with the UK, the rate cutting cycle is expected to be a bit slower and to trough at a higher level. Eurozone has had 2 cuts, as I said already, more expected this year. And if you look into the outlook for 2025, the expectation is rates will come down more aggressively than in the US. Now, I'm not going to talk at length, and there's numerous things we can discuss in Q&A. Some areas have got stronger views on than others, but sterling is an area that has obviously had a relatively sharp move relative to the dollar in recent months. I think we're in the mid 133s now, but we were through 134 yesterday. And that's quite a material rise in recent months relative to dollar. And part of that relates to the slight difference in terms of the rate cutting cycle that is expected. So the fact that rates in the UK are not coming down as much as in the US leads to a bit of strength of sterling relative to dollar. What I don't show in this chart is the Bank of Japan. The Bank of Japan is moving in the opposite direction to other global central banks. Or developed market central banks, in the sense that they are raising interest rates at a time where others are cutting. That's led to a little bit of a strength, or not a little, that's led to strength in the yen. And that was, again, one of the factors which caused significant volatility in equity markets in recent months. Why? Partly relates to what's known as the carry trade. So essentially, investors borrowing in cheap currencies like the yen to invest overseas. And essentially, when interest rates rise in Japan relative to other areas, then that makes the relative cost of borrowing less attractive and leads to a bit of an unwind in that carry trade. So quite significant volatility arising from that differential move in interest rates. And it is likely the Bank of Japan very gradually will carry on normalizing or raising rates. We can move on, James, and I'll try and pick up the pace just to run through a few more of these slides. So that's the macro backdrop. This picture just gives you a sense in recent years of what's been happening at a high level geographically in listed equity markets. And it's been a picture that we've become very used to. There's been volatility in that COVID period, clearly. There's been ups and downs, but the US market is the standout performer. Other developed markets are lagging, emerging markets are lagging further still, and China, bottom of the pack. Now, China, in the last few days, as I said, has actually implemented some long hoped for stimulus. My sense is it's probably not enough. But that has led actually to quite a material upturn in terms of Chinese equity market performance, such that the Chinese equity market is now outperforming the UK and the European equity market year to date. So there's been a bit of an upturn there, but this broad picture is one that we've become used to, right? Where the US is leading, developed markets are following, some way behind, and emerging markets is further behind still. If we can move on, please, James. And within the US, again, the leading global market, again, what we have become used to is the dominance of the Magnificent Seven. That well-known cohort of small number of names, but a very large part of the market now, more than 30% of the market. And the performance there has been very, very strong, as you can see. On the period here, gone a tenfold rise essentially. S&P doing very well, but well behind. What's kind of interesting in my view is if you reflect back on that COVID period, there was a lot of speculation clearly in 2020. People got carried away with the work from home, which I am doing today. It looks like James is as well, and I'm sure many other people are. But what that might mean in terms of corporate opportunities, corporate earnings, and so on. And there's a lot of speculative activity, and names like Peloton Zoom, for example, also benefiting tremendously in terms of share price. Now, the other line, the other blue line on this chart is loss-making tech. So what that's intended to show is companies that essentially don't make profits, but there was a tremendous boom in terms of speculative activity in 2020, looking for companies that might benefit from those longer term trends, and that bubble really deflated very, very markedly, and there's been very little sign of an upturn. So what I would say is the Magnificent Seven have had a setback over the summer. In recent weeks, they've begun to assert their leadership once again. They haven't quite regained that prior peak, so the market in the US is broader than where it was previously, and we think that trend of a broadening in market returns probably persists. But some of the more speculative activity is less evident than it was several years ago. These companies, again, we can debate valuations, but these companies are clearly have got tremendous scale, incredibly successful business models, high level of free cash flow, and dominant market positions. So again, you can debate the valuation, but I don't think we're seeing the levels of speculative activity that we did several years ago. If we could move forward, please. But where does that leave us? It leaves us in the situation that I think you all know, where the US is trading on a premium rating to the rest of the world, and developed markets, excuse me, ex the US, are trading at a premium to emerging markets. That gap is substantial and in large part driven by the overall sectoral composition of those various indices. So the fact that the US has clearly got high exposure to fast-growing, expensive, disruptive tech, such as the Magnificent Seven, explains a large part of the premium rating of the market. And I would say, and again, I don't have the chart in this pack, but a very substantial portion of the outperformance that has been delivered by the US market has been driven by significantly superior growth in earnings from that area. So it's not all about the excess valuations. You can see that there is a premium that one pays for the US market, but superior earnings growth in the Magnificent Seven and the S&P has led to that excess return on the US relative to the rest of the world. If we can move forward once again, please, thanks. Okay, just a couple words on this. So there's a big event coming in a few weeks' time now, and the landscape has changed very, very materially in the past few months with respect not only to who's participating in this race, but you know the probabilities of success. And look, you can look at this in different ways, in the sense that there's numerous different markets that we can look at to try and get a sense about what expectations are, who's most likely to win. I think in recent months, what you can see is there was a huge spike in terms of the probability of a Republican president and a huge drop in terms of the probability of a Democrat president. Why was that the case? Well, you may recall that debate that took place between Biden and Trump, and Biden had a somewhat subpar performance, you might say, and there was a huge rise in terms of expectations that Trump would win the White House. Subsequently, with Kamala Harris stepping in and Biden stepping back, the odds have actually reversed somewhat. From my perspective, and again, there's numerous different aspects to this. There's who wins the presidency, who wins the House, who wins the Senate, whether there's a clean sweep or not, which doesn't actually look that likely from either side, or certainly not as a central case. But it looks like it's going to be very, very close to state the blatantly obvious, and it looks like there will not be a clean sweep. The headlines are Republican President Trump is probably slightly better for equity markets than a Democrat, but I don't think that coming into this election that we are going to have necessarily the type of volatility that we certainly had 8 years ago on the outcome, simply because despite inherent uncertainty and policy and so on, the variables are better known today than they were then. But it's going to be very, very close. I can talk perhaps in the Q&A if there's interest just a little bit about policies and so on. But it's going to be a tight race, and the market is beginning, I think, once again, to think about what implications of various scenarios there are going to be. I'm just going to run through the last couple of slides quite quickly, and then we can. I'm going to pass back to James for any questions. So a lot of information on this slide. I'm sure if you watch on the playback and you have interest, and you can look in more detail at what I'm showing here. But essentially, to my point about focus and diversification, if that is not a contradiction, we have focus components on the portfolio. So I've got a US growth manager, I've got 2 US value managers, I've got a European manager, and so on. Each of those managers hold a relatively small number of stocks. They're selected by specialists, either from within Columbia Threadneedle, or we use third-party managers, not funds, separate accounts. So, for example, we've got £1 billion mandate with JP Morgan Asset Management, run out of New York. They run a US large-cap growth mandate for us. Similarly, we've got a mandate run out of Dallas by Barrow Hanley, who run a value mandate for us. So we blend those strategies together geographically, as well as global strategies with different styles, different approaches, in order to provide diversification, add returns while reducing risk, with the idea of providing a consistent, well-diversified outcome for shareholders. And in addition, we have private equity exposure. Again, I can take some questions on that if you have interest, but that constitutes, when you add it all together, about 10% or thereabouts of our portfolio. We've got a very long history of investment in private equity, and we've got different components there as well. It's well diversified. We've got fund investment, unlisted fund investment, co-investments as well, which is essentially holdings in individual companies that are unlisted. We've got primaries, secondaries. We also have exposure in what we would consider leading, very hard to access growth and venture managers sourced for us by Pantheon, who we partner with in a bespoke basis to provide exposure to that segment of the market. And that's a very long-term series of investments. Typically, if you buy a VC venture capital fund, you're looking at a 12-year initial life, a 10 or 12-year initial life, and it may extend longer. So they're very long-term investments. And historically, we have found that we've had an excess return from private over public exposure, although that has not been the case in the last couple of years, as private market exposure has lagged very strong returns from listed equities. Move on, please, James. And again, not spend too much time on this, but this just gives you a sense about how I've moved the portfolio around in recent years. So this shows year end and end of June positions across some of the main components. So how much we had in US growth, how much in US value, how much in emerging markets, private equity, and so on. And we have in recent years made made some quite significant changes in terms of the growth value trade. We were very long of growth in 2020. We leveled that up, and it actually, as you can see and possibly make out towards the left-hand side there, we ended up being long of US value against US growth in 2022. As things stand now, and has been the case for some time now, we're broadly balanced between growth and value in the US. So the Magnificent Seven have obviously been fantastic performers. We've got exposure to that segment of the market, but we do expect the market will provide broader returns than has been the case up to this point. We're a bit light in emerging markets, and exposure there has been reduced in recent years. China looks very, very cheap. Perhaps what we're seeing is something of a tactical bounce, but for the time being, we're retaining that light position on emerging markets. Again, a lot of detail. I can take questions as you wish. If we move on once again, please, James. When you add this all together, what does that mean in terms of exposure? We've got a lot of our portfolio in North America. This includes private equity as well as public. So more than 60% of the portfolio is in North American assets, largely US. about 10% in Europe, and you can read through the rest of the detail there on the left. And on the right-hand side, this just shows you the sectoral decomposition within listed markets, so how much we've got, for example, in tech and financials and so on. Last slide, I think, from me, is performance. So this just gives a sense of the proof statements of our performance. It's been a fantastic period for investors in equity markets in the last 10 years. And, for shareholders, we've delivered 12% per annum, helped clearly by a fantastic backdrop. But if you look, year to date, 1 year, 3 year, 5 years, it's been a great period, clearly, for investors in equities. This point about consistency is important. We try and be transparent and relatively objective in terms of what we present. So this shows you the absolute. It shows you where we sit against that peer group of other global investment trusts that are out there in NAV terms and in share price terms. There are open-ended funds. Unfortunately, they tend to lag over most time periods what is delivered in the closed-ended sector, and that is demonstrated by the returns in the second last column there. So we're well ahead of them. And then you got the market benchmark as well, and our benchmark is the FTSE All World. So longer time periods where we're a bit ahead of the benchmark. We're well ahead of open-ended funds returns, and we're ahead of comparators in terms of the investment trust sector. So that comes to this point of consistency that we do strive to deliver for shareholders. So I'm going to pause there. I'm going to hand back to James, and I think we may have some time for Q&A.
Yeah, definitely. Thank you very much, Paul. It's quite a comprehensive run around the whole world. A few sort of big picture questions on the sort of macro. First, with currencies moving quite sharply, especially the yen and things like that, are you doing anything to try and manage the currency fluctuations within the trust?
It's a very good question. The short answer is no, not at the present time. However, what I would say, just to add a little bit of colour to that, we have historically taken some positions in currencies really to mitigate what I would regard as a somewhat asymmetric risk that we have. What do I mean by that in English? We're a sterling-denominated fund. Most of our shareholders will be sterling-based in terms of their assets and liabilities, but we're actually taking most of that capital and investing it overseas. So most of our exposure is in non-sterling assets and only a small portion in sterling. So if sterling rises, all else being equal, that will reduce the overall return for shareholders. And year to date, it's not been a problem because sterling has gone up, but it's been a great period. I think there is a case to be made that sterling appreciates modestly from here. I have to say, and that was kind of implicit in what I was saying earlier on, given interest rate differentials, given the fact that the economy's been somewhat more robust than had been expected. We haven't chosen to do anything about that, frankly, because at this point, and my view might change, I don't see material upside in sterling. And also, we've seen quite a pickup in volatility over the summer. And if there is a market event, which I'm not predicting, but is inherently difficult to predict, then the dollar tends to be a very good risk-off currency. So into a period of uncertainty, it is likely that sterling would go down, not up. And therefore, if I take a long sterling position, I lose that natural diversification. Previously, when we've taken some positions on sterling, we've taken a long position on sterling. And we took a £300 million position, actually, a small number of years ago, with a view to hedge against a rise in the domestic currency. But I don't have a currency position right now.
Actually, just to clarify where we are with that, in terms of the fund's own debt, is that all sterling, or have you got a mix of currency with it?
It is almost all sterling. I don't have the exact numbers. We've got some euro-denominated debt in there as well, but it's relatively small. We have £580 million approximately of long-dated debt. Again, I don't have the slide, but it's nicely spread, roughly, my maths are not quite right, roughly 140-ish, 130 to 150 million in maturity buckets of 0 to 10, 10 to 20, 20 to 30, 30 to 40. And the blended average rate of that debt in terms of fixed rate borrowing is about 2.4%. And probably, possibly, most likely, the best trade of my career or investment or decision of my career will be the debt that we took out, which had a 40-year tenor at 1.87% fixed rate. Now, that's a pretty low hurdle rate from which we can hopefully deliver some excess return. Direct answer to your question, a little bit of euro-denominated debt, but largely sterling, very, very low rates of interest.
Question just popped up here. So do you use derivatives to manage exposures at all?
We have the ability to do so. We have done periodically. And one example of that, is in terms of using forward contracts on currencies. We can use futures, but we do not have derivative exposure at present.
Fair enough. Now we talked about the macro quite a bit, but in terms of where you think we are, do you think we are going to see a recession in the US? One of the questions that was put in here was about whether the M2 money supply is indicating that there might be a recession.
Someone is looking at liquidity indicators, probably has got more detail on that than I do to hand. I think that there's a number of indicators which are suggestive, as I said, whether one looks at the yield curve, one looks at some of the labour market indicators. You're getting some indication of potential for a sharper slowdown than is more broadly expected in terms of the US economy. Our view is that the consumer remains relatively robust. There is a point about what we've called the COVID piggy banks in terms of excess savings having been drawn down fully now. And actually the economy perhaps being a little bit more fragile. But fundamentally, the answer is no, we don't expect a recession. And I would say that if we are right, that it will be a soft landing, and if history is any guide, then an environment of rate cuts and soft landing is one where, if you go back to the 1950s, 12 months after the first rate cut from the Fed, which took place last week, you normally get a return in equities of about 20%. So it's quite a good environment for equities. The caveat to that is that it's really quite unusual for equity markets to perform as strongly into that rate cut as we've seen this time. So normally when central banks are cutting rates, it's because of what you've got on your screen here, concern about slowdown, concern about recession, and therefore markets don't perform as well. So we had a very strong run up into the rate cut, but normally after rate cuts, if we avoid the recession, then it's good for equity markets. And that is the key call, right, in terms of the next 12 months.
Yeah.
Recession, so no.
So slightly linked to that then, obviously small cap's been underperforming for ages, partly because of this Magnificent Seven effect.
Yeah.
If we have a sort of benign-ish economy, do you think small cap might outperform? What would the trust do then? What's your small cap exposure like?
Yeah, if you run forward to the slide where I've got the different exposures through time, we don't have a small cap allocation at present. Then if you go to the next one, you can see that we had small cap, global small cap, around the middle of that chart there. It was about 5%. We actually sold out of that in entirety. Your point about small cap underperforming, I mean, everything's underperforming Magnificent Seven, largely. But the small cap has been a pretty poor area for investment for what now has been a relatively long time, as is emerging markets. Classically, into a rate cutting cycle, if you expect ultimately that we'll see a growth upturn, given the extent of underperformance, given where we stand in terms of valuations, then I think there is a case to be made that small cap is looking more interesting, certainly now, than it has done in recent years. So have I done anything about that? No. Will I? Not imminently. I think there are some structural issues which are affecting small cap, and it doesn't negate the obvious comment that there's always great opportunities, there's always going to be great companies that you can invest in the small cap space if you're selective. But in aggregate, you know, some of the dynamics in private markets, I think, have reduced the quality of the overall small cap universe. A lot of that has been taken private. Small cap is more levered, and therefore benefits when interest rates come down. Valuation gap is quite pronounced, but if you strip out the Magnificent Seven, it's perhaps not quite as compelling as you might think. When you adjust for the quality of what you're getting and you adjust for the sectoral composition, again, not quite as compelling. So more cyclical, lower quality, more highly geared. I can see the case from a valuation standpoint, but I am not as yet willing to increase exposure there. But it's a live topic of discussion for us now, and I expect will be as we progress further in terms of rate cuts.
Great, thank you. In emerging markets, obviously China has been disappointing for quite a long time now.
Yeah.
Within your emerging markets exposure, have you got any underweight or overweight to India?
Yeah, generally we've been overweight to India, and you know, India, one of the biggest trades within EM. You know, precisely the demographics, but actually what's going on from a market perspective has been the deflation in valuations in China, and the persistent disappointment in terms of fundamentals, in terms of, you know, underlying growth, macro and earnings, and the translation of that through to shareholder returns. And conversely, the rise of India in terms of the much stronger delivery in terms of market performance. The very large premium that one pays for Indian stocks in general. So the short answer is yes, we're a bit overweight in India against benchmark within that EM complex. Looks to me it's a pretty rich area now. You know, I think that one faces a conundrum in emerging markets, as you do in broader markets, where the cheap areas. When does cheap become value? Real. When is the real value there? And in the last few days, you know, you've seen some inkling that perhaps China valuations have reached the point where you just need a bit of a positive catalyst, and that will lead to a change in mindset and flow. Conversely, India, there's a lot in the price, but for now we're a bit overweight. Our underlying managers see high quality companies with good growth prospects. They're trading rich, but they continue to deliver decent earnings growth.
Thank you. Can you just expand a bit on the US election and how you think that might impact on the portfolio, please?
Yeah, so in terms of the US, so I think in big picture terms, if there is a Republican, if the Republicans are in the win, or if we get Trump rather than Harris, that is expected to be more positive for the equity market than not. So we're geared, and we've got a slightly pro-growth stance, without wanting to contradict what I said between growth and value. If you look all the way through, it's a little bit more growth. What would happen if Trump wins? If Trump wins, there's going to be higher tariffs, more protectionism. That's probably going to lead to slightly higher inflation, because the US is quite a closed economy with around 15%, only around 15% imports. There's talk of taxes, corporate taxes being cut from current rate of 21 to 15%. So that would be, you know, all else being equal, good for the corporate sector. So a bit more inflationary, more tariffs, probably better for earnings growth with, you know, respect to those potential tax cuts. And I have seen estimates of maybe 4% addition to US EPS if those tax cuts were implemented. Contrast that with Harris. She is proposing to raise corporate taxes from 21 potentially to 28%. So, and extend taxes on buybacks. So that'd be bad for EPS growth. Increased long-term capital gains tax. Does that sound familiar? Up to 28%. on high earners. And there's numerous other aspects. What are we doing about it? We haven't taken an overt position. Again, and I don't want to sit in the fence, but I am. I mean, it looks too close to call. I think it's often quite short-sighted, quite often, not always, and there are some examples where it's not, to take market views on the basis of short-term politics. The most likely outcome is that you're not going to get a sweep. I think the Republicans, I'm just looking at the odds here, the Republicans have got a 74% chance of winning the Senate, but only a 36% chance of taking the House. And when you get that split outcome, it means that some of these proposals get watered down, and therefore the impact on markets becomes less pronounced than the first order effect. And therefore those EPS estimates that I reflected earlier on, it might be a fraction of that. And frankly, given market moves and volatility, that's not going to be as significant, perhaps. I think that the only additional point I make is, again, if one reflects back in 2008, and that was a shock. 2008. Did I say 2008? 8 years ago. That was a shock to markets in terms of the outcome. Now I think markets are relatively well prepared. So there may be a bit of volatility, but I don't think we're going to see big swings one way or the other, unless something. I shouldn't say that, because there is an element of unpredictability with the candidates.
Yeah. Just to finish up, then, there's a couple of questions about the discount. So yes. I think it's about some 9.5-ish now.
Yes.
Do you feel like that's too high?
Yes, I think that's too high. And the logical question from that is, what are we doing about it? So it's wider than we would like. We have stepped up buybacks. If my memory serves me correctly, we bought more than 8 million shares in 2023. Year to date, we've bought back, I think, about more than 19 million shares, and we are buying back continually in order to, absorb that excess supply. And we will step up buybacks as required, because it's the right thing to do. It's accretive to NAV if you buy a discount, but we don't think buybacks are necessarily the panacea. And therefore, what are we doing? Well, firstly, we think we've got good performance. We think we've got consistent performance. So I think it's somewhat anomalous to have the discount where it is, with actually us having delivered good returns for shareholders in terms of, not only shareholder returns, but underlying NAV. But we're working very hard in terms of promotional activity. Having the opportunity to speak to you and to listeners and people that are seeing this is great in terms of putting out the message. And we have a very active PR campaign, marketing campaign. So we're trying to address the supply side of things through buybacks, and we're trying to create incremental demand through effective marketing. But it's an ongoing process. The board are very, very focused. And as you said, with discount around 9% or thereabouts, we are very focused on doing the right thing for shareholders. I would say, I think it was in Q1 last year. It wasn't Q1 last year. We were trading at a premium. So it wasn't that long ago. We had a premium rating. And we issued shares in 2018 and 2019 small, and have bought back shares continually when we have the emergence of a discount. So things can change, reasonably quickly. And we think the underlying fundamental picture is sound in terms of the investment trust.
Great. Thank you very much indeed, Paul. We covered a lot of ground, and I think it was quite useful. So, and thank you again for doing this at short notice as well.
Thank you very much. Thanks for the opportunity. Good to see you.
Now, before we all go, we've got something to announce. So we have decided to do an awards program. This is a whole new invention. And there's a big difference between this and any other awards that you'll see in the sector, in that we are asking you, the investing public, to choose the winners. So this is why it's called the Investors' Choice Awards. Very kindly, Stage Fleming have sponsored it for us, and that's helping us do a couple of things, but one of them is to provide a prize. So the mechanics of this will be announced on the website shortly, There'll be something on there this afternoon. The actual voting will open at 8 AM on Monday. And we're going to ask you to choose winners from each of 10 categories. So there are 4 nominees in 9 categories and three nominees in 1 category. So we're just saying, of those nominees, which one would you choose? The people who get closest to choosing the winners across all of those 10 categories with a chance of winning £5,000. To get there, to get the nominees to whittle down from a long list, we asked a panel of experts, and we were really pleased actually to get some real sort of big hitters here in terms of the people that help whittle those numbers down. So there they all are, and thanks very much again to them for their time and effort going into that. They were looking at 5-year numbers. But not just at 5-year numbers, a whole mix of different things about why the nominees were best in each category and why they thought you'd been like them. In terms of the practicalities, there'll be a link published on our website and sent to subscribers on Monday, and you're going to have all the way through till close at 5 PM on the Sunday the 17th to get those voting done. And we're really looking forward to seeing the outcome of this. So please do participate. It obviously doesn't cost you anything to do that. We just a little bit of your time, and it would be, I think, useful for the whole sector to get this successful. So thank you very much. There'll be more to say on our website about this later on today. And in terms of the show, we will obviously be back next week. So we'll be talking to Richard Brown from Castleknoll, and we've got a full lineup all the way through, as I say, till the end of the year. One other change, we've had to move European opportunities actually into 2025. So we have actually got a lineup in 2025 as well now. But they're being replaced by Bluefield Solar. So have a good weekend, one and all, and I will see you next Friday.